the biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income, and that's a problem. The question is, and they're going to spend more than they're going to earn, where are you going to get the money from?
Ray Dalio, who founded Bridgewater Associates in 1975 and grew it into the largest hedge fund in the world, is widely regarded as the most well-known macroeconomic investor in the world. Nonetheless, the investment community takes notice when Ray Dalio speaks. And just recently, Ray gave us an update on where he thinks the economy is right now, where we are in these short and long-term debt cycles, and where he thinks markets are headed over the next few years in an exclusive 25-minute interview on CNBC. With inflation at record highs, interest rates on the rise, economic growth slowing, and stock prices plunging, it's important to get Ray's take on where we are in the business cycle. Hello and welcome back at Financial Fortune, where we bring you the latest insights and analysis on the economy and financial markets.
These things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth, and so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance, and of course that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt, then you have inflation, then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trashy. Cash is pretty attractive now. Now cash is relatively attractive. So it's attractive in relation to bonds. It's actually attractive in relation to stocks. You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you're seeing it reflected in not only, long duration stocks, those that didn't have cash. So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash. All of that comes down. So you could see which sectors are going down. You could see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, but doesn't mean that their families are hurt, because the household sector is in a better financial position than it ever was, because it has received a lot of money, and also they're benefiting. When we say inflation and you say wages are going up, you see their sector, they're basically benefiting. So you're seeing this type of contraction. So it's going down, and we're having something close to a let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate, something like that, right? But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's we're in a classic one of those. but we keep building up the debt. And then there are issues in terms of the issue of the dollar and what's happening in terms of the world and the value of money. But I think that this type of recession is not a bad recession. It's a lot less bad than I thought it would be, because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world, because we're selling all this debt. You know, if you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, okay? And now we're having a problem selling that money around the world. Right. And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds. Well, I think the biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem, right? Governments run the same as your household or a business, in that, with two exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less? Right. Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive, and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So, you know, how do you solve that problem? I think that, you know, if you were to, let's say, take the bigger picture, there's a lot of things that you can invest in that will produce returns. And I think, for example, I don't think we invest nearly as much in the basic things like great education and making sure that certain areas do not have conditions that are substandard conditions. And so to invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing. Other things. But this is part of a cycle, a big cycle that has happened over and over and over again.
Where do you think the stock market is? Do you think that we have priced in what could be a recession, or what is a recession? Did we see the worst of it in October? Where are we right now in terms of valuation?
I think the markets as a whole look, they were obviously, I would say, the interest rate changes were obviously had to come. The impact on the other markets had to come. They have come. They have been into the price. So now you're going to have probably a tightening or a tighter monetary policy than existed. And that's a net negative for the stock market, but not in such a big number that it's like a big bearish thing. So when I look at the market as a whole, I would say, okay, well, now it seems closer to fairly priced, probably still a bit high, given that whole picture.
And that concludes our video on Ray Dalio's warning for the economic crisis and U.S. recession. It's always important to stay informed and aware of the potential risks in the market, and we hope this video provided some valuable insights. If you found it helpful, please give it a thumbs up and consider subscribing to our channel for more updates and analysis. Thanks for watching.